As activity and liquidity ratios are closely related, we will discuss them here. Activity ratios are also known as asset utilization or operating efficiency ratios. These measure how efficiently a firm is using its assets. Asset turnover ratio, that is revenue divided by average total assets, is the most common activity ratio, and it measures how many dollars of sale was the firm able to generate from each of the dollar invested in assets. Keeping other things constant, the higher is the asset turnover ratio, the better it is. A low or a declining asset turnover ratio may mean that sales are sluggish or a heavy investment in asset which is inefficient has been made, or the plant needs modernization, and it may also indicate that the company needs to actually change its business strategy in future. A low or declining asset turnover ratio may also indicate that the company needs to change its asset structure or mix. Activity ratios can be computed for any category of assets such as fixed asset turnover, tangible asset turnover, intangible asset turnover, or working capital turnover. The three most common activity ratios are the working capital turnover, the fixed asset turnover, and the total asset turnover. The numerator in all these three ratios is the revenue of the firm, while the denominators are average working capital, average net fixed assets, and average total assets for each ratio respectively. Other common activity ratios include inventory turnover ratio. It is calculated as cost of sales divided by the average inventory. Average inventory is calculated as the opening inventory plus the closing inventory divided by 2. Keeping other things constant, the higher is this ratio, the better it is. In certain cases, higher inventory turnover may be indicating the risk of stock out as inventory levels are too low. Therefore, a comparison against industry benchmark competitors as well as past ratios for the same firm should be provided. Days of inventory on hand is also known as days required to sell inventory, or the average number of days held in storage. It is calculated as the number of days in the period divided by the inventory turnover. The number of days in the period usually equal 365 days in the year. However, in some text and in some places you might be finding that they are using 250 or 260 days. Keeping other things constant, the quicker inventory is sold, the better it is. So the days of inventory on hand, the lower it is, the better it is. If inventory turnover ratio is low or the days of inventory on hand is high, it may indicate that inventory is obsolete or sales are slowing. It may also indicate that the company is planning for an increase in sales and therefore building up inventory. If inventory levels are too low, it can result in shortages and missed sales due to stock outs. It is useful to compare revenue growth with the industry and then compare the growth of inventory with the growth in revenue. Ideally, the growth in inventory should be lower than or similar to the growth in revenue. Receivable turnover is calculated as revenue divided by average receivables, and again, the higher is the receivable turnover, the better it is. It measures how quickly the firm is able to receive cash from its customer on credit sales. The receivable turnovers can be expressed in times also, and it is calculated as the number of days in period divided by the receivables turnover, and it is called the days of sales outstanding or the days required to convert receivables into cash. For example, if the days of sales outstanding is equal to 25, it means on average the company takes 25 days to receive cash from customers who the company sold goods on credit. Typically, the low and declining DSO measure indicate better efficiency. When DSO is high, it may indicate credit issues, but too low might indicate stringent credit policies that could hurt competitiveness. It means the company has too strict credit policy that customers are not willing to buy from it. For a detailed analysis of the days of sales outstanding or receivable turnover measure, you should compare the credit period allowed by the company the sales growth of the company relative to the industry, and the actual credit losses, that is bad debts of the company. Payable turnover ratio is calculated as purchases divided by average trade payables, and if purchases is not available, then you can also use the cost of goods sold, which is theoretically not correct, but practically if purchases is not given or available, then you can proxy it using the cost of goods sold. The number of days of payables is calculated then as number of days in the period, for example 365 days divided by the payables turnover, and it is indicating the average number of days to pay suppliers from whom the company purchased on credit. Generally, the number of days of payables, the higher it is, the better it is. However, it may lead to delinquency, so drag this period as much as possible, delay the payments to suppliers as much as possible without becoming delinquent. This would indicate better efficiency. Number of days of payables is too long or the period is increasing in length, it may suggest impending liquidity issues. Also, it is possible that suppliers may be extending long-term payment terms. Therefore, you have to carefully evaluate that. This would require you to compare other liquidity and solvency indicators. Cash conversion cycle at the same time is a liquidity ratio and is also considered an activity ratio. The cash cycle measures how long does it take for the firm to go from cash to cash. In the case of a service company, it sells the service and receives the cash, so its cash conversion cycle is very short. A merchandising company, on the other hand, may purchase inventory on credit, store it for some time before it is sold. Even when it is sold, it may not be for cash, it may be accounts receivable, which may then take further time to convert into cash. And once cash is received upon cash sales of inventory or from the accounts receivable, then it makes the payment to the supplier from whom inventory is purchased. So relatively, the merchandising company will have a longer cash cycle. For a manufacturing company, it will be even longer because it will be purchasing raw material which it will process into finished products, and then those finished products will be sold on cash or on credit, and it may take longer if it is sold on credit to convert it into cash. Once the cash is received from cash sales or from customers, it will be then used to pay for material, labor and other overheads. The cash conversion cycle is also known as net operating cycle, and it is calculated as the days sales outstanding plus the days inventory held minus the number of days of payables. These are the same that we discussed on the previous slide. For example, if the DSO is equal to 45 days and the DOH is equal to 25 days, and we have the days of payables on hand, let's call it DOP, equal to 15 days, then the cash conversion cycle will be equal to 45 plus 25 minus 15, that is equal to 45 plus 25 is 70 and then minus 15, so it is equal to 55 days. Now cash conversion cycle is very important, particularly in terms of liquidity, because the amount of working capital that is needed, which is equal to current assets minus current liabilities, is directly related to the cash conversion cycle. So if a company has higher cash conversion cycle or longer cash conversion cycle, it would require more investment in working capital. We covered liquidity ratios when we talked about the balance sheet in week 6. As we know, liquidity refers to a company's ability to meet its short-term obligation. The level of liquidity needed differs from one industry to another. A particular company's liquidity position may also vary according to the anticipated need for funds at any given time. Judging whether a company has adequate liquidity requires analysis of its historical funding requirements, current liquidity position, anticipated future funding needs, and options for reducing funding needs or attracting additional funds, including actual and potential sources of such funding. Liquidity ratios reflect a company's position at a point in time, as these are balance sheet ratios, and therefore typically use data from the ending balance sheet rather than the averages. The current, quick, and cash ratios reflect three measures of a company's ability to pay current liabilities. Each of these ratios use a stricter definition of liquid assets. For example, the current ratio includes all current assets. However, the quick ratio only includes cash, short-term marketable investments, and accounts receivables and does not include inventory. The cash ratio, on the other hand, also excludes accounts receivable in addition to inventory and only uses cash plus short-term marketable investments as current assets. Next, we discuss solvency ratios, most of which we discussed in week 6 in balance sheet analysis. However, there are few that we need to cover here. Solvency ratios measure how well the company is positioned to meet its long-term liabilities. There are broadly two types of solvency ratios: debt ratios and coverage ratios. Debt ratios measure how has the company financed itself. These include debt to total assets, debt to equity, and debt to total capital ratios. Lower debt ratios indicate lower financial risk and hence more safety. Coverage ratios, on the other hand, measure the degree to which earnings or cash flow of the firm can decline without affecting the firm's ability to pay its interest or other fixed charges. These include the EBIT, interest coverage ratio, which is calculated as the earning before taxes plus interest payments divided by interest payments, and the fixed charge coverage ratio, which is calculated as EBIT plus lease payments divided by interest payments plus lease payments. Unlike debt ratios, higher coverage ratios indicate safety. So the higher the coverage ratio, the better it is. The last category of ratios that we are discussing now is the valuation ratios. Valuation ratios relate the firm's performance or financial position to its market value. The price to earning ratio, that is the PE ratio, is probably the most widely used indicator in valuing equity securities. It relates the share price of the firm to the earning per share of the firm. Generally speaking, a high PE ratio indicates that the market places a high value on the earnings of a company, while a low PE indicates that the market is placing a low value on the earning of the company. For example, we have two companies, Company A and Company B, and the EPS of Company A is expected to be $5. And the EPS of Company B is also expected to be $5. However, the market price of Company A is $100 per share and of Company B is $50 per share. The price to earning ratio for Company A is 20 and the price to earning ratio for Company B is 10. It means that investors are willing to invest $20 to buy 1 pound of earnings or $1 of earnings in Company A. However, the same investors are only willing to invest $10 to buy $1 of earning in Company B. Higher PE stocks are also known as growth stocks. Lower PE stocks are known as value stocks. A higher PE ratio may reflect expectations for higher growth in earnings in future. Also note that sometimes a firm may have a high PE ratio because it has very low earning per share. PE ratios and other price-based ratios such as price to book value, price to cash, and price to sales ratios are used in equity analysis. These ratios effectively are used by equity investors in combination with financial ratios to assess the performance of companies that are classified or considered as value stocks or growth stocks. It also helps in confirming if the market valuation is consistent with the financial performance of the firm. Inconsistencies may help identify mispriced stocks. Price earning ratios are calculated using net income as the denominator, so it can be sensitive to non-recurring earnings or one-time earnings events. Also, net income is generally considered to be more susceptible to manipulation than are cash flows. Analysts may use price to cash flow as an alternative measure to the EPS, particularly in situations where earnings quality may be an issue. The price to sales ratio is calculated in a similar manner. Sometimes it is used as a comparative price metric, particularly when a company does not have positive net income. So when a company is having losses, in such situations, the price to sales ratio may be quite useful. It may be also useful when cash flows are negative. Although the price to sales ratio is common, there is a theoretical mismatch in the numerator and the denominator. The numerator is the price that refers to the price of a share of a common stock. However, the sales relate to all providers of capital, not just the common stockholders. Therefore, enterprise value to sales is considered a more theoretically correct metric. The price to book value ratio, on the other hand, is interpreted as an indicator of market judgment about the relationship between a company's required rate of return and its actual rate of return. Assuming that book values reflect the fair values of the asset, a price to book value ratio of 1 can be interpreted as an indicator that the company's future returns are expected to be exactly equal to the required rate of return by the market. A ratio greater than 1 would indicate that the future profitability of the company is expected to exceed the required rate of return, and the values of this ratio less than 1 indicate that the company is not expected to earn any excess returns. The two most common dividend related ratios are dividend payout ratio and dividend yield. Dividend payout ratio is equal to dividend per share divided by earning per share. In other words, it is equal to the dividend paid to common shareholders divided by the net income available to common shareholders. Dividend yield, on the other hand, is the dividend per share divided by the price per share. The dividend payout ratio measures the percentage of earnings that the company pays out as dividend to shareholders. It reflects the company's dividend policy. Optimal dividend policy is a function of many factors. However, a company balances current dividend payout with future growth requirement. The amount of dividends per share tends to be relatively fixed because any reduction in dividends has been shown to result in a disproportionately large reduction in the share price. As dividend amounts are relatively fixed, the dividend payout ratio tends to fluctuate with earnings. Therefore, conclusions about a company's dividend payout policy should be based on examination of payout over a number of periods. Here we have selected credit ratios used by Standard & Poor's as part of credit analysis of industrial companies. The source is Standard & Poor's Corporate Rating Criteria 2008. Before calculating ratios, rating agencies make certain adjustments to reported financials, such as adjustment to debt to include off-balance sheet debt in a company's total debt. The FFO is the fund from operations, defined as net income adjusted for non-cash items. It is not the same as the CFO, which is the cash flow from operations. In other words, the cash flow from operation is the number that we get from the cash flow statement, while the funds flow from operation is equal to net income plus minus non-cash expenses or revenues. These ratios include EBIT interest coverage ratio and EBITDA interest coverage ratio, FFO interest coverage ratio, FFO to debt ratio, free operating cash flow to debt ratio, discretionary cash flow to debt ratio. The numerator in each ratio is listed in this column here, and the denominator for each ratio is provided in the last column here. Other ratios used in credit analysis by Standard & Poor's include the return on capital, the net cash flow to capital expenditures, the debt to EBITDA ratio, the total debt to total debt plus equity ratio. Ratio analysis is only one part of the credit analysis. The credit rating are not assigned solely based on ratio analysis. Other qualitative and quantitative factors are also considered and evaluated. Analysts often need to forecast future financial performance. For example, analyst EPS forecasts are widely followed by Wall Street. Analysts use data about the economy, industry, and company to arrive at a company's forecast. The result of an analyst's financial analysis, including common size and ratio analysis, are integral to this process along with the judgment of the analyst. Based on the forecast of growth and expected relationships among the financial statement data, the analyst can build a model which is sometimes referred to as an earning model to forecast future performance. Of course, a forecast should not just be a mechanical exercise of extrapolating from historical performance and historical ratios. However, information gained from ratio analysis from prior years can provide useful inputs. Often, a forecast begins with a revenue forecast. A revenue forecast would generally be based on numerous factors, but one input to sales forecast can be percent change from prior year as shown on the horizontal common size income statement. Then, to forecast income, an analyst can use ratios expressing the relationship between revenues and various items on the income statement. An analyst may use historical common size data as an input to developing expectations about specific expense line items. The gross profit margin, the operating profit margin are all used in this case. Similarly, to forecast balance sheet, different ratios related to balance sheet items are quite useful in making an assertion about future values of capital expenditure and borrowing and issuing of new shares, etc. Once the income statements and balance sheets are forecasted, the cash flows can then be estimated based on the forecasted income statement and balance sheet data. Forecasts often involve iterations because the amount of borrowing is a function of the cash flow requirements, which are a function of the earnings and taxes, which depend on income net of interest expense. And interest expense is a function of the amount of borrowing. One common solution is to forecast interest expense based on the balance of the borrowings at the beginning of the period. This solution is generally acceptable in situations where decisions are not overly sensitive to the exact level of interest payment in each period. Alternatively, the Excel solver function may be used to iterate for a solution.